Imagine you're an avid cryptocurrency investor who's been closely following the market for years. You wake up one morning just like any other day and reach for your phone to check the latest prices. But today, something seems different. The cryptocurrency you've been closely tracking, Stellar Coin, has experienced a sudden and massive surge in value, reaching an all-time high. You can hardly believe your eyes. Your initial excitement is quickly followed by a sense of curiosity and concern. Why is this happening? Is it sustainable or is it just a bubble waiting to burst? As you sip your morning coffee, you ponder over the factors that might be driving this unprecedented price increase. What could have caused such a rapid and substantial jump in SC's value? Is there something happening behind the scenes that you might have missed? Your mind races with questions, and you can't help but wonder if there's more to the story than meets the eye. Hey there, Cryptonauts! Welcome back to another exciting episode of the Cryptoholics Corner, the ultimate destination for all things crypto. Today we're diving headfirst into the captivating world of cryptocurrency volatility. Buckle up because we've got an exhilarating journey ahead as we explore the intricate components that shape both long-term and short-term volatility in the crypto space. Whether you're a seasoned trader, a curious investor, or just someone looking to demystify the chaos, this is the place to be. Without further ado, let's dive into today's episode of the Cryptoholics Corner. Don't forget to like, subscribe, and hit that notification bell so you never miss an electrifying update. Now let's get started. Cryptocurrencies have entranced the global stage due to their ability to introduce groundbreaking changes and revolutionize conventional financial frameworks. Yet, amidst this excitement, a persistent issue arises in the form of inherent price volatility, a captivating and concerning aspect. Our investigation commences by breaking down the immediate triggers that reverberate across cryptocurrency markets, causing significant disruptions. These triggers encompass a spectrum of factors such as major economic shifts, announcements of regulatory measures, shift in market sentiment, and breakthroughs in technology. As we dive into these rapid and impactful catalysts, our goal is to decipher their collective impact on price fluctuations. This process involves unveiling how seemingly tranquil market conditions can swiftly transform into chaotic and unpredictable scenarios, akin to the sudden transformation of serene waters into tumultuous waves. Our first trigger are market sentiment shifts. The impact of market sentiment on cryptocurrency prices is profound. Positive news, endorsements, partnerships, and media coverage can lead to periods of euphoria and rapid price appreciation. Conversely, negative news, security breaches, or regulatory uncertainties can trigger panic selling and sharp price declines. The emotional and psychological aspects of investor sentiment play a pivotal role in driving short-term price movements. Secondly, we have regulatory announcements. The regulatory environment greatly influences the behavior of cryptocurrency markets. Announcements of new regulations, legal actions, or government policies can create substantial uncertainty and trigger significant price swings. Market participants often react swiftly to perceived threats or opportunities resulting from changes in the legal and regulatory landscape. Thirdly, we have technological developments. Innovations and changes in blockchain technology and protocols can have a substantial impact on cryptocurrency prices. Updates, forks, security vulnerabilities, or breakthroughs in scalability can create volatility as the community adjusts to new possibilities or challenges. Technological changes can reshape the fundamental value proposition of cryptocurrencies, leading to both rapid price surges and corrections. These three factors collectively showcase the intricate interplay between human psychology, regulatory influences, and technological advancements, which ultimately shape the dynamic and often unpredictable nature of cryptocurrency markets. Delving deeper into our exploration, these foundational elements, often referred to as fundamental drivers, wield a significant influence on shaping the long-term trajectory of digital asset values. Our first element is supply and demand dynamics. One of the central pillars of cryptocurrency volatility is the interplay between the supply of a particular cryptocurrency and the demand for it. The scarcity of some cryptocurrencies, often achieved through mechanisms like limited supply caps or deflationary features, can amplify price movements. Rapid changes in demand, driven by factors such as increased adoption or sudden loss of interest, can result in significant price swings. By comprehending these supply-demand dynamics, we gain insights into how scarcity and perceived value contribute to price volatility over the long haul. Our second element is adoption trends. The adoption and integration of a cryptocurrency into real-world applications and industries hold immense sway over its value. As more businesses and individuals begin to use a particular cryptocurrency for transactions or investment, its utility and demand increase. Conversely, stagnation or setbacks in adoption can lead to prolonged periods of lower demand and price decline. Analyzing adoption trends allows us to gauge how well a cryptocurrency is fulfilling its intended purpose and how it aligns with broader economic trends. Our last one is network security and resilience. The robustness and security of a cryptocurrency's underlying blockchain technology also significantly impacts its price stability. Instances of successful or attempted hacking, vulnerabilities, or major network disruptions can trigger sudden price drops, eroding investor confidence. On the other hand, enhancements in security measures and technological advancements can bolster confidence and positively influence prices. Understanding the relationship between network security and market sentiment provides crucial insights into the potential risks and rewards associated with various cryptocurrencies. By closely scrutinizing these fundamental concepts, we aim to eliminate the driving forces that hold the power to elevate cryptocurrencies to new heights or instigate extended downturns. The intricate dance between supply, demand, adoption, and technological resilience paints a comprehensive picture of a cryptocurrency's potentials and risks. As we navigate this landscape, our goal is to equip ourselves with a deeper understanding of how these long-term factors intertwine to shape the captivating and sometimes tumultuous journey of cryptocurrency value fluctuations. This multifaceted journey requires insights from economics, finance, technology, and psychology, each playing a unique role in assembling the puzzle of factors that shape this captivating phenomenon. Starting with economics, we delve into the fundamental principles of supply and demand, market efficiency, and behavioral economics. These concepts help us dissect how market participants' decisions and perceptions collectively impact price movements. Finance then steps in, providing tools to analyze risk, market sentiment, and portfolio management strategies. By bridging the gap between traditional and financial theories and the unconventional realm of cryptocurrencies, we gain a deeper insight into the intricacies of price dynamics. The technological facet cannot be overlooked, as advancements in blockchain technology and network protocols underpin the very existence of cryptocurrencies. A profound understanding of these technological underpinnings allows us to evaluate the robustness of different cryptocurrencies, assess security vulnerabilities, and anticipate how technological changes might trigger shifts in market sentiment. Moreover, the human element comes into play through psychology. Emotions, biases, and cognitive patterns significantly influence investor behavior, driving short-term fluctuations. Understanding the psychology of market participants sheds light on why prices can rapidly swing from exuberance to fear, sometimes without apparent rational justification. By weaving together these diverse disciplines, we connect the dots between macro and micro perspectives, short-term triggers, and long-term fundamentals. This interconnected framework enables us to perceive the intricate dance between various factors that contribute to cryptocurrency volatility. As we aim to decipher this complexity, our nuanced perspective not only enriches academic research but also equips practical investors with a more informed approach to navigating the turbulent waters of cryptocurrency markets. In essence, this interdisciplinary journey transforms the once enigmatic realm of cryptocurrency volatility into a decipherable landscape, where insights from economics, finance, technology, and psychology converge to offer a comprehensive view. Through this lens, we gain a better grasp of the factors driving both the academic discourse and real-world investment decisions, contributing to a more informed and rational understanding of this captivating and rapidly evolving domain. Thank you for joining us today on the Cryptoholics Corner. We've taken a deep dive into the fascinating world of cryptocurrency volatility, exploring the factors that drive those wild price swings. Indeed, it's been an eye-opening journey, and we hope you've gained valuable insights into the dynamic nature of digital assets. Remember, knowledge is key when it comes to navigating the ever-changing landscape of cryptocurrencies.